Imagine walking into a warehouse store on an ordinary Tuesday afternoon. You're there to grab milk, some chicken breasts, maybe those bulk almonds everyone raves about. But as you scroll through the membership app while waiting in the produce section, you notice something unusual in the merchandise category, a product you never expected to see here. Not cryptocurrency, not investment funds, something physical, something tangible, something that your grandmother probably kept in a safe. Within hours, thousands of people are doing the same thing you are, refreshing their apps, checking inventory, waiting for restocks. By sunset, the inventory counter reads 0. By the next morning, it's restocked. By lunch, it's empty again. By nightfall, the supply chain team is scrambling to figure out what just happened. This isn't a limited edition gadget. This isn't a viral product everyone's talking about on TikTok. This is something that sits in the financial margins of mainstream consciousness, until suddenly it doesn't. And when it doesn't, when ordinary people start treating a commodity like a Black Friday sale item, it tells us something profound about what they're thinking, about what they're worried about what they believe is coming. Today, we're going to explore what's actually happening in the precious metals market, why it matters, and what it reveals about economic anxiety in America right now. For generations, precious metals occupied a very specific niche in American investment culture. They belong to a particular archetype, the libertarian with strong opinions about monetary policy, the prepper building a bunker, the elderly investor who remembers when the dollar was backed by gold, or the sophisticated collector who understood numismatic value alongside metal content. Mainstream America? They had 401ks. They had mutual funds. They had statements from Vanguard and Fidelity arriving quarterly. The idea that a typical person, a teacher, an accountant, a nurse, a small business owner, would spend their evening researching silver purity grades or comparing dealer markups would have seemed absurd just a few years ago. But something has shifted. Over the past 18 months, major retail channels that cater to middle-class families began introducing precious metals products. We're not talking about specialty dealers hidden in strip malls. We're talking about the stores where families buy their weekly groceries, their household supplies, their bulk pantry items. The democratization of access combined with something else entirely, mainstream adoption. The metrics tell a fascinating story. Search volume for terms like buy silver and physical gold has increased dramatically among age groups that traditionally showed little interest in these assets. Social media discussions about metal stacking have moved from fringe communities into mainstream forums. Dealer waiting lists have grown from weeks to months. And perhaps most telling, the people buying these products aren't the usual suspects anymore. According to data from major retail channels, the demographic profile of precious metals buyers has shifted dramatically. Previously, the average buyer was male, over 55, and had prior experience with precious metals investing. Today, first-time buyers represent nearly 40% of transactions. Women now account for a significant portion of new buyers. Age ranges have compressed, with people in their 30s and 40s entering the market in meaningful numbers. What changed their minds? The answer isn't some single event. It's cumulative. It's lived experience. Over the past few years, Americans witnessed something that textbooks and financial institutions had spent decades telling them was impossible: sustained inflation. Not the theoretical inflation discussed in economics classrooms. Real inflation, experienced daily, grocery receipts that seemed to inch upward every week, rent increases that outpaced wage growth, gas prices that swung wildly based on global events seemingly beyond anyone's control, home prices that doubled in some markets within a 5-year window. Simultaneously, they watched central banks respond to crisis after crisis by doing the same thing: printing money. In 2008, the Federal Reserve expanded its balance sheet dramatically. The same happened in 2020. Each time officials assured the public that this was temporary, that inflation was transitory, that everything was under control. And each time, people looked at their real lives, their shrinking purchasing power, their rising costs, their stagnant wages, and thought, something doesn't add up. Then they started seeing their neighbors and co-workers discussing alternatives. Online communities dedicated to precious metals exploded in size. YouTube channels exploring monetary history and financial system vulnerabilities gained millions of subscribers. Podcasts interviewing investors and economists warning about currency debasement became surprisingly popular entertainment. For the first time, precious metals stopped being relegated to financial fringes. It became part of dinner table conversation. It became something people mentioned at work. And crucially, it became something accessible. When major retailers began offering these products, competitive pricing, easy purchasing through familiar platforms, return policies from trusted companies, it removed the friction. You didn't need to find a sketchy dealer. You didn't need to wire money to some website. You didn't need to feel like you were doing something unusual. You just needed to add silver to your cart, like you would anything else. Here's where the situation becomes genuinely interesting from an economic perspective. The precious metal supply chain is not designed for mass retail adoption. It never has been. The infrastructure exists to serve industrial demand, central bank purchases, and niche investor communities. When sudden mainstream demand hits, the system reveals significant constraints. Global annual silver production hovers around 850 million ounces. This sounds enormous until you understand how it's distributed. Roughly 55% goes to industrial applications, electronics, solar panels, pharmaceuticals, various manufacturing processes. About 20% goes to jewelry. Only about 15-20% goes to investment demand. The remainder goes to recycling and other uses. The refining infrastructure that produces investment-grade bullion, 1-ounce coins, 100-ounce bars, sealed tubes meeting specific purity standards, operates at different capacity than the raw silver market. A major mint might produce 50-100 million ounces annually of investment product. There are only a handful of these facilities globally, and they operate within pretty fixed parameters. What happens when investment demand suddenly spikes? Lead times extend. A dealer who normally receives shipments every 2 weeks might suddenly face 6-week waits. Premiums, the markup above spot price, begin to increase. This happens because dealers face uncertainty about resupply costs. If they sell inventory at a premium of $3 per ounce, but C8 replace it at that cost for 2 months, they'll increase premiums to protect margins. Inventory at retail channels depletes quickly. Why? Because retail buyers don't have sophisticated understanding of supply chains. They see a product available at what seems like a reasonable price, and they buy. They buy without worrying about whether premiums will be lower in 3 weeks or whether they should wait for a dip in spot price. They just buy. This creates a fascinating paradox. The more accessible precious metals become through mainstream retail, the faster available inventory disappears, making them less accessible. The supply situation gets more complex when you understand the distinction between a spot price and physical availability. Spot price, the price you see quoted on financial terminals, reflects the commodities market. This is where bulk traders, hedgers, and speculators trade contracts. It's efficient, it moves quickly, it's based on massive volume. But crucially, it's not necessarily reflective of what physical metal actually costs in the real world. When demand spikes, particularly retail demand, there's often a disconnect. The spot price might stay relatively stable while physical premiums explode. Why? Because the spot market and the physical market are actually two separate ecosystems that normally have low friction between them. But when demand shifts rapidly, friction appears. A dealer might quote $35 per ounce for spot silver, but charge $43 per ounce for physical 1-ounce coins. That $8 premium represents not just markup. It represents scarcity value, delivery certainty, and the cost of operating with constrained supply. From a pure supply and demand perspective, this makes complete sense. Supply is relatively inelastic. You can't suddenly triple refinery capacity. You can't convince miners to increase production significantly without price incentives. And even then, it takes time. When demand increases rapidly, price has to adjust, or scarcity appears, or both. What's genuinely notable is how quickly this manifests at the retail level. Within days of widespread availability at major retailers, inventory can disappear. This tells us the demand is real, distributed across a large population, and not easily suppressed by price alone. The precious metals phenomenon is ultimately not about precious metals. It's about economic sentiment and trust. Fiat currency, the dollar, the euro, any currency not backed by physical commodity, functions on a foundation of collective agreement. It has value because we agree it has value. The moment that agreement breaks down, the moment people stop believing the currency will retain purchasing power, fiat currency becomes significantly less valuable. Throughout most of modern history, particularly in stable developed economies, this collective agreement remained strong. Americans didn't question whether dollars would be usable tomorrow. They questioned whether stocks would go up or bonds would go down, but not whether currency itself would function. Over the past several years, that agreement has frayed, at least at the margins. When someone decides to convert paper currency into a physical metal, they're making a specific statement. They're saying, I don't trust the trajectory of this currency. They're saying, I believe that my purchasing power is being eroded. They're saying, I want to own something outside the financial system. This isn't irrational. This is pragmatic. This is someone looking at their real experience and making a decision accordingly. The fascinating part is who's making this decision. It's not the usual suspects. It's the middle class. It's people with stable jobs, with houses, with 401ks. These aren't doomsday preppers. These are ordinary people who shop at warehouse clubs and trust mainstream retailers. When mainstream people start making decisions that were previously associated with financial fringes, it's worth paying attention. From a behavioral economics perspective, this represents what researchers call preference revelation. People's actions reveal their actual beliefs more honestly than their words ever can. If someone says they're not worried about inflation, but their actions suggest they are, specifically converting wealth into hard assets, their actions are revealing their true sentiment. The scale of this revelation is what makes it significant. It's not one person, it's not 1,000 people. It's potentially millions of people making independent decisions to reallocate small portions of their wealth toward physical metals. Why does this matter? Because if this trend continues, if it accelerates, if it spreads to other demographics and other retail channels, it has real consequences for the financial system. Not catastrophic consequences necessarily, but real ones. Consider a scenario where 5% of American households, roughly 6.5 million households, decide they want to own $5,000 worth of physical precious metals. That's $32.5 billion in demand. Against annual investment demand of roughly $20 billion globally for silver, this represents a significant disruption. The supply can't handle it without some combination of prices rising dramatically, premiums exploding, lead times extending to many months, or availability simply disappearing from retail channels. We're actually watching the early stages of this play out. Dealers are reporting constraints. Premiums are higher than they've been in years. Lead times are extending. Retail channels that tried to offer these products are discovering that maintaining inventory is difficult. This is where economic theory meets real-world friction. If we zoom out and think about larger systemic implications, several interesting dynamics emerge. First, there's the relationship between physical metals and the broader financial system. The paper precious metals markets, futures contracts, ETFs, mining stocks, are enormous and highly leveraged. Physical metal represents only a small fraction of total precious metals exposure globally. When there's a disconnect between physical supply and paper market pricing, it creates what's called basis risk. This is the risk that you can trade something profitably on paper, but find it difficult or impossible to take physical delivery. Historically, this gap was small. The arbitrage between paper and physical pricing was tight. Sophisticated traders could easily buy paper, take delivery, and sell physical at a profit, and this activity would prevent large price divergences. But if physical supply genuinely tightens, if refineries are running at capacity, if retailers are sold out, if premiums are so high that arbitrage becomes unprofitable, this mechanism breaks. And when market correction mechanisms break, prices can move dramatically. Second, there's the question of what this signals about broader financial system confidence. The Federal Reserve and other central banks operate with the assumption that citizens will hold currency and use the banking system. If that assumption begins to shift at scale, if people increasingly prefer to hold physical assets outside the system, it creates pressure. This doesn't mean immediate collapse. The financial system is resilient and has multiple stabilizing mechanisms, but it means there's stress. And stress, if it continues accumulating, eventually manifests in unexpected ways. Third, there's the political economy dimension. If precious metals shortages become real and visible, if people go to retailers looking to buy and find nothing available, if premiums spike to levels that make purchase inaccessible, it becomes a political issue. Politicians will respond. They might respond by investigating dealers for price gouging. They might respond by restricting trading. They might respond by promoting digital currencies as alternatives. History shows that governments don't respond well to situations they perceive as loss of control. The precious metal shortages of the 1970s, for example, led to policy responses. It's reasonable to anticipate similar responses if shortages become widespread and visible. Fourth, there's the question of what this means for inflation expectations and monetary policy. If ordinary people are taking defensive action against currency debasement, it suggests inflation expectations are drifting higher. It suggests people don't believe official inflation data. It suggests they think the real cost of living is rising faster than the government acknowledges. This has implications for how policymakers respond to inflation. They might conclude that trust in their inflation data has eroded and that they need to implement more aggressive tightening. Or they might conclude that the solution is to increase supply and drive prices down. Or they might do some combination. First, it's worth understanding that precious metals have a legitimate role in diversified portfolios. This isn't fringe financial advice. Major institutions recommend some allocation to non-correlated assets. Physical precious metals have properties that are distinct from stocks, bonds, and real estate. They don't require counterparty trust. They don't depend on company earnings or government solvency. They're not denominated in any single currency. For someone concerned about financial system stability or currency debasement, a modest allocation makes sense. Common frameworks suggest 5 to 15% of net worth in physical metals, depending on personal risk tolerance and beliefs about systemic risk. The key word is modest. The goal isn't to make a fortune. The goal is insurance. If you believe there is a meaningful probability of significant inflation or financial instability, you're buying insurance. Insurance is never costless. You hope you never need it. But it provides peace of mind and protection if something unexpected happens. Second, there's the practical question of what to actually buy. For someone entering the market for the first time, simplicity matters. 1 ounce silver coins, American Silver Eagles, or generic rounds are straightforward. They're easy to sell. They're widely recognized. They have modest premiums compared to industrial bars. 100-ounce bars offer lower premiums per ounce. The dealer markup is smaller on larger items, but they're less liquid. If you need to sell in a hurry, finding a buyer for 100 ounces is harder than finding a buyer for 100 individual ounces in coin form. Gold versus silver is a personal choice. Gold has smaller volumes, so you hold less weight for the same dollar amount. Silver has industrial applications, making it potentially more valuable in certain scenarios. Many people own both in varying ratios. The important thing, buy actual physical metal, not mining stocks, not ETF shares, not digital gold, actual metal that you can hold. Third, there's the storage question. Some people keep metals at home in a safe, hidden carefully. The advantage is complete control. The disadvantage is security risk and insurance complications. Others use allocated, segregated storage, professional vault facilities where you own specific bars or coins, but they're stored professionally. The advantage is security and insurance. The disadvantage is you're paying fees and trusting a third party. Others use deposit boxes at banks. This provides security but creates accessibility problems during financial crises. The right choice depends on personal circumstances, the amount owned, and risk tolerance. Fourth, there's the cost consideration. Premiums vary. Buying from established dealers who are likely to exist in 5 years is more important than buying at the absolute lowest possible price from a dealer you've never heard of. Lead times matter. If you order today and it takes 3 months to arrive, that's fine. If you order hoping for immediate delivery and it arrives months later, that's frustrating. Diversifying dealers makes sense. Don't put all your purchasing with one entity. And understand that you're likely not going to make money on modest holdings. If you buy silver at $35 per ounce with an $8 premium, you're paying $43. For you to break even, silver needs to reach $43 in the market. For you to profit, it needs to go significantly higher. This is fine. That's not the purpose. The purpose is wealth preservation, not speculation. If your wealth is preserved because you held something stable instead of experiencing currency debasement, that's a win. If you're trying to understand whether this precious metals phenomenon is a real structural shift or temporary noise, there are several metrics worth monitoring. First, inventory levels at retail channels. Do they restock quickly after selling out? Do they increase inventory over time? Or does inventory dwindle and availability disappear? If precious metals stop being offered at major retailers because they can't reliably stock them, that's a meaningful signal. Second, premium levels. Are premiums stable, rising, or falling? If they're consistently rising and high, it indicates supply tightness. If they're falling and stable at low levels, it suggests adequate supply meeting demand. Third, dealer wait times. Are they increasing or decreasing? How far in advance do you need to order to get reliable delivery? Fourth, the composition of buyers. Are they still primarily older investors, or are younger demographics increasingly entering? Are women increasingly represented? And this suggests whether the phenomenon is widening or staying concentrated. Fifth, media coverage and mainstream awareness. As more people become aware that precious metals are an option, do more people buy? Or does awareness not translate to action? Does it become a normal conversation topic, or does it remain niche? Sixth, price movements. If precious metals fundamentally shift from financial margin to mainstream safe haven, we'd expect price appreciation, not immediately, but over time. Are we seeing that? Seventh, government response. Are policymakers paying attention? Are they discussing regulation? Are they concerned? Government attention often correlates with something being perceived as significant. None of these are guarantees, but together, they paint a picture of whether we're watching a real shift or a temporary spike. Zooming out, the precious metals phenomenon sits within a larger context of economic uncertainty. Real interest rates remain negative or near zero in many developed economies. This means savers are losing purchasing power by holding currency. This creates incentive to own alternatives. Government debt levels are historically high. This raises questions about long-term fiscal sustainability and what happens if those debts can't be serviced without currency debasement. Inflation, while currently moderating from recent peaks, remains elevated by historical standards. Wage growth is only partially keeping pace. Younger generations, in particular, are facing a cost of living crisis relative to previous cohorts at similar life stages. Global supply chains remain fragile. Wars, pandemics, and political instability demonstrate how quickly supply of essential goods can be disrupted. Technology is centralizing financial control through digital platforms. For some people, this creates discomfort about financial freedom and independence. In this context, precious metals offer something simple: A physical asset outside digital systems, outside counterparty risk, outside currency-specific exposure. It's not a comprehensive solution to any of these concerns, but it's a tool people can control individually. The fact that ordinary people are reaching for this tool without coordination or media hype pushing them to do so suggests their concerns are genuine. When you see ordinary people making decisions that were previously associated with financial fringes, it's worth asking, what are they responding to? The answer isn't some hidden conspiracy. It's not based on false information or irrational panic. It's based on lived experience. People look at inflation in their actual lives and don't see it matching official statistics. They look at their purchasing power and see it declining. They look at the trajectory of government debt and financial obligations and feel uncertain about the future. And they're taking modest, rational action to protect themselves. The precious metals phenomenon isn't a prediction that everything collapses. It's not a guarantee of any particular outcome. It's simply people expressing, through their purchasing decisions, that they want optionality. They want to own something outside the system. They want insurance. Whether that insurance ever proves necessary is secondary. The fact that so many people feel the need to buy it tells us something. It tells us that confidence in the current system is eroding. It tells us that people don't believe official narratives about inflation and stability. That's the real story here. The physical shortage of precious metals at retail, if it continues and accelerates, is a symptom of this erosion. It's not the cause. The cause is loss of confidence. The shortage is just what that loss of confidence looks like when it manifests as purchasing behavior. For individuals trying to navigate this environment, the takeaway is straightforward. Understand the system you're part of, evaluate your risk exposure, and take modest steps to protect yourself if you believe the risks warrant it. For policymakers and observers of markets, the takeaway is equally straightforward. When ordinary people start making extraordinary decisions, pay attention. They're telling you something. They're revealing what they actually believe, independent of expert opinion or media narratives. The precious metals movement isn't fringe anymore. It's mainstream, and that changes things. Not immediately, not catastrophically, but ultimately, when millions of people decide they want to own something outside the system has to reckon with that. It has to provide the means for them to do so, or it has to restrict them, and restriction creates its own set of problems. We're at an interesting inflection point. The outcome isn't determined, but the signal is clear. People are moving. They're protecting themselves. They're expressing through their actions a belief that the current trajectory is unsustainable. What comes next depends on how systems, financial, political, economic, respond to that signal. But one thing is certain. The people who paid attention to the signal will be better positioned than those who dismissed it as noise.